Hello everybody, at this time we are talking about portfolio selection. Portfolio selection refers to the methodical process of deciding which assets to include in an investment portfolio. This process aims to create a balanced and diversified portfolio that maximizes returns while managing risk according to the investor's preferences and goals. It involves analyzing various asset classes, understanding their risk-return profiles, and determining the optimal asset allocation. And then we move to key concept in portfolio selection. The first concept, risk and return. Every investment carries a degree of risk, which is the possibility of losing some or all of the invested capital. Typically, assets with higher potential returns come with higher risks. The challenge in portfolio selection is to balance this risk with the expected returns to achieve the investor's objectives. Second, expected return and portfolio variance. The expected return of a portfolio is calculated as the weighted average of the expected returns of the individual's assets. Portfolio variance, which measures risk, is determined not just by the variances of individual assets, but also by their covariance with each other. A lower portfolio variance indicates lower risk. And then third, diversification. Diversification involves spreading investments across different asset classes like stocks, bonds, real estate, etc. And within those classes like different industries and regions to reduce the impact of poor performance from any single investment. The goal is to create a portfolio where the overall risk is lower than the sum of the risk of the individual assets, as the negative performance of some assets may be offset by the positive performance of others. And then fourth, correlation and covariance. Correlation measures how two assets move in relation to each other. A correlation of 8 means the assets move together. -1 means they move in opposite directions. And 0 means no relationships. By combining assets with low or negative correlations, an investor can reduce the overall risk of the portfolio. Covariance, a related concept, is used to calculate the combined risk of a portfolio. And then fifth, asset allocation. Asset allocation is the process of deciding how to distribute investments among different asset classes, such as equities, bonds, and cash. This decision is crucial because it largely determines the portfolio's risk and return characteristics. The asset allocation should reflect the investor's goals, risk tolerance, and time horizon. For example, A younger investor with a long-term horizon might allocate more to equities for growth, while a retiree might prefer bonds for income and capital preservation. And then we move to steps in portfolio selection. The first step, assessing risk tolerance and investment goals. The first step in portfolio selection is to assess the investor's risk tolerance and investment objectives. Risk tolerance varies from one investor to another depending on factors such as age, financial situation, investment horizon, and personal comfort with risk. Investment goals may include growth, income, capital preservation, or a combination of these objectives. And then second, analyzing asset classes. Different asset classes such as stocks, bonds, real estate, and commodities have distinct risk-return characteristics. Analyzing these characteristics helps one understand how each contributes to the overall portfolio's performance. Stocks generally offer higher returns but come with higher risks, while bonds provide more stable returns with lower risks. And then third, diversification and optimization. Diversification is a key principle in portfolio selection. It aims to reduce risk by spreading investments across various assets that are not perfectly correlated. By combining assets with different risk and return profiles, investors can achieve a more stable and optimized portfolio. Optimization involves using quantitative techniques such as mean variance optimization to identify the most efficient asset allocation that maximizes returns for a given level of risk. And then we move to challenges in portfolio selection. Despite its importance, portfolio selection is not without challenges. Investors must navigate various obstacles to create and maintain an effective portfolio. The first, about market volatility. Financial markets are inherently volatile, and predicting future performance is challenging. Effective portfolio selection requires staying informed about market conditions and making adjustments as needed to manage risk and seize opportunity. Second, changing goals and circumstances. Investment goals and personal circumstances can change over time, necessitating regular portfolio reviews and adjustment. Life events such as retirement, career changes, or major expenses may require shifts in investment strategy to ensure alignment with current needs and objectives. And then third, behavioral biases. Investors may be influenced by cognitive biases such as overconfidence or fear, which can affect their decision-making process. Recognizing and mitigating these biases is crucial for making rational and objective portfolio selection choices. And then, what tools and resources are commonly used for portfolio selection? Various tools and resources can assist in portfolio selection. For example, first, financial advisors. Professional advisors provide personalized advice based on individual financial situations and goals, guiding portfolio construction and management. Second, investment software. Tools like robo-advisors, investment platforms, and financial planning software automate portfolio selection and rebalance based on predefined criteria. Third, research and analysis. Access to market research reports, financial news, and performance analysis tools offer insights into potential investments and market trends. And fourth, education and learning. Online courses, investment books, and financial literacy programs equip investors with the knowledge needed to make informed decisions. Using these resources enhances the ability to create and maintain a diversified, well-performing portfolio. I think it is enough. Thanks for watching.